This is alarming. I'm your host, Steve Van Metre, and thanks for joining me today. And our lead story today, Goldman's urgent warning sparks fears that a consumer crisis is imminent. And as we head into the holiday season, as you're about to see, the timing of this could not be worse. Plus, we're about to see one of the world's largest property developers do the unthinkable, and I'm going to show you why more companies like them are about to go under. And we're also seeing renewed stress in U.S. small businesses, suggesting that many of them may not be around a whole lot longer. And if you're wondering what we're doing in a toy store today, well, I'm not getting my Christmas shopping done early. Well, we've got retail sales data, and it suggests that the U.S. consumer is just about tapped out. And we've got a sponsor for today's show, Canadian North Resources. You can find them on the TSXV under the symbol CNRI and on the OTC under the symbol CNRSF. They are a critical metals developer and explorer for the clean energy, electric vehicle, and high-tech industries. And wait till you see the amount of resources this company is sitting on. You're going to want to understand why we think they are an incredible long-term play. Stay tuned to the end of the show or check out the pinned comment or description for more information. Now let's head over to Bloomberg, where we picked today's story up with Country Garden. We've had them on the show before, but look what's happening. We said this was likely to happen as bondholders are yet to get interest as the deadline looms. The problem is that it's what type of deadline, and it's all about the dollar here, because what have we been talking about on the show is we're seeing a global dollar shortage. That's why companies like Country Garden are having trouble paying on their debt, and why there's going to be more Country Gardens, not just in China, but all over the world. The looming obligation marks the first major test for China's former top developer after it warned last week that it won't be able to meet all of its future offshore payment obligations. That was the strongest indication yet that it's set for a debt failure and restructuring. Now keep in mind, when you hear this offshore, they're referring to US dollars. This company needs dollars. They're not talking about yuan in this case. The company has $9.9 billion of dollar notes, there you go, outstanding, which would make it one of the country's biggest ever restructuring. So rather than likely default, which is where they're headed, they're just going to go to all the bondholders and say, hey, here's how this is going to work. Either we can not pay you, or you're going to take these terms. And of course, the bondholders are going to go crazy because they want their money. And then when Country Garden shows them their financials, they're going to restructure the debt to Country Garden's favor. Now the question is, will that actually fix the problem, or will it kick the can down the road? I'm going to show you why we're just kicking the can down. It's all due to the Fed. Potential delinquencies or a messy restructuring by Country Garden threaten to send China's housing sector into a deeper turmoil. Because what did we talk about just the other day? That Chinese consumers don't want to buy homes. And could you imagine why? If the largest property developer is not able to pay its debt, how are they going to build your home? Of course, you're thinking that's not going to happen. And if you think it's a problem with Country Garden, then you're wondering, well, what other developers are having that issue? And the simple answer as a consumer is just don't buy a home. As it has several times, the number of projects run by Evergrande, whose default 2 years ago sent shockwaves across Chinese markets. And let's talk about why this is. Why are they having a dollar shortage when they just go out into the broad market and get them? Well, the issue is, when you're in China, how do you get dollars? You get them through global trade. And so what needs to happen is U.S. consumers need to demand Chinese-made goods. And so then they order them, and those goods get produced, put on container ships, come to the U.S., in which time they're not paid in yuan. We pay in dollars. Those dollars go back to mainland China. They get into their financial system, and that's how companies like Country Garden get them. So the problem is, what happens when we see a downturn in the global economy, particular imports into the U.S., we're already sowing the seeds for the next crisis in China. And it's a catalyst, as I'm about to show you. It's all due to the Fed. Here you can see imports of goods and services. This is into the U.S., and this is not just including China, it's including all imports. And here you can see on a year-over-year rate of change against the federal funds rate. And what I want you to understand is, as the Fed raises rates, what you see is imports tend to go down at some point. There's times it goes down ahead or in sync with it, but generally as the Fed raises rates, import growth slows down. Now this may be if what you're thinking is, hey, this tells us that monetary policy actually works. And the answer is Nope, has nothing to do with it. Here's what I want you to be thinking is when U.S. consumers can earn a prevailing good rate of interest on their money, what are they going to do with it? They're going to put their money in the bank and collect interest and tell everyone they know, their family, their friends, coworkers, their kids, put your money in the bank because you're getting free money. And don't go spend it on anything because it's not worth it. But when interest rates go down, what do consumers tend to do? Spend the money. And when they spend it, those dollars flow overseas. So what you're seeing here is actually not monetary policy so much, but the Fed inciting people to save their money rather than spend it. And sure enough, here you can see going into the pandemic, the Fed was raising rates, and lo and behold, imports were coming down. We're seeing the same effect now. It's just a choice when you give people the option to make interest or spend their money. Well, as we're seeing, they're going to actually save their money. And for China, who needs dollars desperately, this isn't the way they're going to get them. And the problem is if Country Garden's having this problem, that means other property developers are going to have the exact same problem. As the Fed should stop rate increases with the U.S. small business struggling. This according to Harker, who's now one of the biggest doves on the FOMC board. He said small firms are really struggling with access to capital. As some banks I've talked to are concerned that their business plans just aren't going to be able to make it at higher interest rates. I heard that warning a lot over the summer, he says. So as we look ahead and say, what is actually affecting the U.S. consumer here that Goldman is so concerned about? First, we start to see there's a dollar shortage in China and other parts of the world. Now we get to the Fed saying, hey, there's a problem in the banking system. In fact, the problem here is usually lower rates. So the fact is, he just said, some of the bankers I talked to are concerned their business plans aren't going to be able to make it at higher rates. Well, that doesn't make any sense, because you'd assume that higher rates would be good for banks until you realize why it's not. And it has everything to do with the fact that Harker is completely clueless about how our monetary system works and doesn't understand that an inverted yield curve, that is when higher short-term rates are higher than long-term rates, don't help banks well at all because they borrow at the front end and lend at the long end, meaning they lose money on those loans. So here we have the net percentage of domestic banks tightening lending standards to firms of all sizes in blue against the 10-year, 2-year Treasury yield curve. And that's when we look at any time the red line is below the horizontal black line, that means the yield curve's inverted. That means short-term rates are higher than long-term rates. And wherever you see the blue line above that horizontal black line, that means on net banks are tightening standards. So what do you see? Fed inverse yield curve, lo and behold, banks tighten standards because they don't make money lending. They did it again during the global financial crisis. They did it going into the pandemic, and they're doing it now. So what the banks are telling Harker, and he doesn't get it, and I want you to prove to you he doesn't get it, because look at what he says. This is why we should hold rates steady. Well, that's not the answer. We should not at this point be thinking about any increases, because if that's true, and it is true, then we should let that ride out. And what he doesn't realize is they're inverting the yield curve. I want you to understand they have no clue how the system works, because what he should say is, hey, wait a minute, we're the ones causing this problem for the banks, and we need to bring short-term rates down to normalize the yield curve. You'll notice he didn't say that. He said we need to keep rates higher, but not go any higher. Harker in recent months has come out as one of the Fed's biggest doves, arguing policymakers have already raised interest rates high enough to quell inflation, and I totally agree with that. Now, there's a statement I can get behind, because when we look at the yield curve and we then compare it to inflation, so now we've got the consumer price index up there in blue on a year-on-year rate of change. What do you see? Curve inversion, inflation comes down. Curve inversion, inflation down. Curve inversion, inflation down. Curve inversion, inflation rises, then comes crashing down. Inversion, inflation down, inversion, and everyone says inflation goes higher because it all comes back to the banks. You don't create enough new money in a debt-based economy, well, that means people can't spend it. But lo and behold, for some reason, again, this is why we're in the toy store today, U.S. consumers are out spending. The real question is, for how much longer? As U.S. retail sales top forecasts and sign of durable consumer demand, suggesting that consumers don't care about higher interest rates. They are outspending, but the import data doesn't suggest that. So what's really going on here? Well, let's look at the positive side of the story as the news is spinning it today, and then we'll show you the real story. The value of retail purchases unadjusted for inflation increased 0.7% after an upwardly revised 0.8% gain in August, suggesting consumers are going crazy to spend, and excluding gasoline, September sales advanced 0.7%. The so-called control group sales, which are used to calculate gross domestic product and exclude food services, auto dealers, building materials, and gasoline station, rose at better than expected 0.6%, showing the U.S. consumer is effectively resilient. Raise rates all you want, we're still going to spend, and all that tells central bankers is, well, we need to raise rates even more. The advance showcases a consumer that's still powering ahead despite the recent energy-driven pickup in inflation. While wage growth is starting to lose steam, and we'll look at that here in a bit, the labor market remains generally strong, offering Americans a leeway to keep spending. And that's the issue here, is can Americans continue to spend? Now, I want to go note here that how far back is this report? Well, it tells you that this is from a couple of August. So we're looking backwards here a little bit. And notably behold, what do experts say? The death of the U.S. consumer has been greatly exaggerated. And of course, this is good. It's an all-around report that shows continued strength in consumer spending. Again, the question here is for how much longer? Sustained strength in consumer demand in the aftermath of September price data shows stubborn inflation, risk prompting the Federal Reserve policymakers to raise interest rates again before the end of the year. And let's look deeper in the report here and find out where the spending was going. Well, we know it was going to auto and other motor vehicle dealers. So people were out buying new cars. And then where did they go? They got in those cars and they drove to the health and beauty store. And they wanted to look good, cruise around their new vehicle. But then they ran out of gas, so they stopped at the gasoline station. And after there, they went to some miscellaneous store retailers before they went home and got on some non-store retailers and ordered some stuff online. And that's the picture here of what we see of the U.S. consumer right now. Is they wanted to buy cars, they needed gas, and they wanted to go shopping. The question is, how did they get the money, and how much longer is that money going to last? Well, what we need to do is now go back and look at the recent consumer credit data. And here, what did we find out? The revolving consumer credit owned and securitized. Look at that big pop here. Now, that tells you that consumers were out borrowing money. And where did that feed into? Well, if you're saying, hey, wait a minute, I think it went into retail sales. You got it. Now the question becomes, as I wanted to present this to you, is the question now is how much more credit can consumers get their hands on? Because I'm going to show you, they talked about wages. We're going to look at that. It's all about access to credit when they hit the limit. And we don't know. We don't know where the limit on the credit cards is at. We keep thinking we're close to it. We're not there yet. But when we hit that wall, you watch consumer spending tank. But how about of what we look at the actual data here? This is what everyone's excited about. There's your soft landing. There's a bounce off the zero line. This here, advanced retail sales shown on a year-over-year rate of change. But how about we adjusted for inflation? No problem. It's looking okay too, saying that maybe consumers are really strong here. And all I'm saying is it's about their access to credit because they don't have the income they used to. As we can look at this chart here, when we now overlay a retail sales shown in blue against total compensation. This is your average weekly hours multiplied by average hourly earnings of production and non-supervisory employees. That's in red and on a year-over-year rate of change. So what do we notice is that when wage growth slows down, what happens? Spending goes down. Lo and behold, no surprise. And sometimes when inflation takes off, as we see here going into the dot-com bubble, wages aren't growing fast enough, and that means consumer spending comes down. We see it again here during the global financial crisis. We see wage growth slow. We notice retail sales slow, and they both start heading down almost together. And now look, what do we see? Retail sales rising, total compensation growth slowing. And what does that tell you? It's all about the access to consumer credit. And so now we go back to what Harker said. He said, hey, wait a minute. The banks are saying they can't make money at higher interest rates, so we should just not raise rates anymore. That's because he doesn't get it. And now let's take a look at what's likely to happen for retail sales coming soon. And here we can see again, now we're overlaying advanced retail sales shown in blue against the net percentage of domestic banks tightening standards for commercial industrial loans to firms of all sizes when you cut credit access to commercial, whether it's commercial borrowers or retail borrowers, doesn't matter who. You start cutting money creation, spending has to go down. Here you can see as banks tightening lending standards in red. Now this is above the horizontal black line. What happens? Retail sales eventually roll over and head down. How about the global financial crisis? Makes sense. Don't have money, can't spend it. How about the course of pandemic? That was the obvious one. But look now, everyone's saying, look, there's going to be a rebound. And we're saying no. Once banks get to the limit where they don't want to lend any more money to people and they cap off their limits, you watch, consumer spending is going to outright tank. They don't have the income. And now this all comes back to Goldman's urgent warning of why we're facing a consumer crisis, perhaps sooner than this headline data shows. As Goldman warns about shipping recession as consumer sputters. Now, this doesn't make sense because this came out on the same day as a retail sales report. But remember, retail sales is always behind like all the other data we look at. And now we're looking at shipping data. And this is more critical because if stuff isn't leaving ports out of China and coming to the U.S., then it tells us there's a problem brewing. Since global shipping peaked during the COVID pandemic, AP Moeller Maersk has warned about an emerging downturn in the container shipping market. Goldman now forecasts a lengthier and potentially more severe downturn in the shipping industry, recommending to sell for the shipping diet. They say, quote, "We believe market expectations are still too complacent on the depth and duration of the coming shipping recession, suggesting there is too much supply and not enough demand." And one of the problems is when you face periods of inflation, you'll notice we're seeing container rates go back to where they were in the 2018, 2019, 2020 years. And that's a problem because costs have gone up, and that is going to impact shippers. It's going to impact producers and consumers all across the board. In fact, in August, Maersk warned about waning global demand for shipping containers by sea, suggesting people aren't ordering as much. It's why we talk about the new orders so often. The company transports Chinese-made goods for retailers such as Walmart, Nordstrom, Macy's, and Kohl's, all of whom have warned about a consumer slowdown. And Goldman's report offers even more evidence that the global economy is on shaky grounds as Western consumer appears to be sputtering. Now again, you don't see this in the retail sales report, at least not yet, amidst central bankers' aggressive rate hiking cycle to tame the worst inflation in a generation. So you can see we're getting there. And that's why when I see headlines like this next one, it makes absolutely no sense to me at all. As holiday spending to grow 14% this year, as Deloitte survey shows, they're saying college debt, low wage growth is hurting middle-income consumers, but more shoppers are looking for deals and looking to spend more money, and I don't get it. I don't think that comes to fruition. I think that's optimistic at best, but one thing that we are bullish on, that's a sponsor for today's show, Canadian North Resources. Let's check them out. They're on the TSXV under the symbol CNRI and on the OTC under the symbol CNRSF. Again, everything in the description, pinned comment for you. Let's take a look because all of their information is down there too. They are a Canadian mining company at late stage exploration. And wait till you see what all the exploration has been done on this property and the development of a mining property located in Nunavut, Canada. The company owns 100% of the Ferguson Lake project that has abundant base metals, copper, nickel, cobalt, and platinum group metals, such as palladium, platinum, and rhodium, and those they've got a ton of. So check this out because they're, again, pulling critical metals for the clean energy, electric vehicle, and high-tech industries, and we know these metals are going to be in a big demand because we're highly dependent on things of these metals from other countries like China. So we know that any project that's close to home here in the U.S., in this case Canada, is going to get a lot of attention. And look at this. They've got a ton, literally, of copper, nickel, cobalt, palladium, platinum, all kinds of stuff here. And they have spent, I mean, there's not, let me rephrase that. There's been a total spend of $180 million in the exploration, metallurgical tests, and site upgrades. Not all, of course, by Canadian North, but they own it all now. And that's the best part. Here you can see in Nunavut, Canada, they're an emerging major mining district. They've got gold mines, they've got the nickel, copper, and PGM mineralized zones and anomalies. That's their Ferguson Lake project. This is hot project with tons of stuff there. And there's been extensive exploration, infrastructure, and mineral resources by Inco, Starfield, and now Canadian North Resources for a total whopping $180 million spent doing all the development and the research into this project, and they've got a ton of stuff there. You can go to their website and read more about it. As the Ferguson Lake project covers an area of 256.8 square kilometers, consisting of 10 contiguous mining leases over an area of about almost 9,700 hectares, surrounded by 11 exploration claims over an area of 15,700 hectares. All leases are 100% owned by Canadian North Resources. The property is situated in the western Churchill province and northwestern Herein domain area with a mainly Archean, metavolcanic, and metasedimentary rocks and extensive genetic terrains. And extensive target mineral zones across the Ferguson Lake property are magnetic copper, nickel, cobalt, massive sulfide deposits with palladium, platinum, and rhodium mineralization. These zones are spatially related to mafic and ultramafic intrusions, which are principally in the form of fine to coarse grain gabbros. A second type of mineralization consisting of low base metal sulfides and high PGM grades is situated significantly beneath and along the footwall walls of these massive sulfide lenses within the mafic, ultramafic intrusions. All this to say is they've got a whole bunch of stuff, and they're looking forward to realizing what's underneath the ground here, and that's what makes Canadian North Resources a huge long-term opportunity. As the mandate of CNRI is to create shareholder value from the advancement of this Ferguson Lake project, a significant potential producer. The Ferguson Lake project holds over 71 million tons, got that, containing substantial resources of copper, nickel, cobalt, palladium, and platinum. These estimates are for the west zone and the west extension zone. They're less than 6 kilometers in length along a 15-kilometer mineralized belt. And they've got a corporate team that's experienced, seasoned, and dedicated to build asset value and realize all those metals underneath that property. And that's why we're saying that Canadian North Resources, again, under TXSV, CNRI, and on the OTC under CNRSF is a long-term value. Now, keep in mind, this stock is not widely traded. That's why we're not showing you a chart for it, but keep in mind, that's why we're saying long-term value in this property. As you can see, 180 million spent already on the exploration. We know what's under the ground. It's only a matter of time before they start pulling it out. And as always, with any company we feature on our show, you're under no obligation to purchase their stock. Be sure to do your own research before buying or selling any security. And with that, I'm Steve Van Metre. Thanks for watching. Thanks for being fans. Bye now.